Hey, how's it going, PIXY team? In this video, I'm going to talk about the science behind the 5-minute pullback. Now, I did present this at ProfitCon in front of a lot of our Academy members. However, I thought it would be better if I went through the entire slideshow alongside you guys within the group lesson studio so you guys can get kind of a refresher as well as seeing it more in depth. I didn't have a ton of time to talk about it at ProfitCon as there's other things I wanted to go over. Now, if you guys would like to see the entire presentation, go to the very bottom of the course. We're going to have the presentation posted there for you guys to be able to watch the entire thing. However, this is just the science behind the 5-minute pullback. So without further ado, let's get right into it. Alrighty, so this has to be the most anticipated group lesson, but B, this has to be probably my best work or some of my best work. And the reason I say that is because I have not heard of another trader who's gone this far deep into the science behind trading, who's came up with these theories, who's figured this out really, and I believe in the future when I write a series of day trading books. This will be probably what's most popular about my books, as well as this is what eventually has made my first million. Is simply this rule. So going into it, what is a 5-minute pullback? Okay, now I called on some guys in when I was presenting this at ProfitCon. And a lot of you guys said it's a breather period. It's a moment of rest. It's a consolidation period. Those are good answers, okay? That is quite literally what a pullback is. It is a counter move to the overall move of this said movement or stock. Now remember, a pullback can go in the positive or negative direction. A lot of you guys who've been here for a while and seen me make some awesome short plays, I say a 5-minute pullback to the upside. That's a pullback. It's still a pullback. And some other things I have. The first pullback is kind of an uncertainty if this is, is this like actually going to happen? Is this kind of an algo spike? Why is this running, right? That's the first overall pullback. A lot of traders are kind of hesitant, like, okay, is this going to make a new move? Or is this just kind of a coincidence? Another reason why I love a 5-minute pullback is it can tell me how positive the catalyst is. If a stock rips 100% and pulls on back, then rips another 100% and pulls on back, and rips another 100%, that catalyst is pretty good. If it rips 5%, pull back 5%, pull back 5%, the catalyst was not so good. So based off of how quick the first and second pullback are, it can help me gauge how good of a catalyst it is. How can we capitalize on them, right? Gives us a proper time to enter. It does exactly that. Today, I was looking for ATXI to give me a 5-minute pullback to enter for a move higher. It gives me a great entry point, and not a lot of traders know you can enter off those. That is when experienced traders have their stop losses filled off of pullbacks. Inexperienced. Experienced traders purchase these said pullbacks and ride the wave higher for a new high. It also helps gauge how aggressive our price target should be. If this stock rips 100+% before the first pullback, I know, generally speaking, the second pullback, I should have 100+% price targets or around there, right? I shouldn't have 10% gain price targets if this stock ripped 100% the first time it really opened up. And also, it helps me gauge when the overall move is going to be over. I can gauge the size of the waves, I can count the waves, and more importantly, I can tell when it's time for correction, or I can tell, okay, there's time for a move higher, right? Does anyone know? Shoot, does anyone know where I based my theory, my 5-minute pullback theory off of? It's a theory. Some guys knows that. Yep, there you go. The Elliott wave theory, right? Has anyone heard of the Elliott wave theory other than ProfitCon? So the Elliott wave theory that we're gonna go into in just a moment is how it's able to judge or kind of come up with this 5-minute pullback lesson. Okay, so the Elliott wave theory was a theory created by an accountant, not a stock trader, by Ralph Nelson Elliott in the early 1930s. Basically, what he said was he was able to figure out predictable stock patterns based off of the movement of the overall crowd or the herd. It's called a herd mentality, right? If you see sheep all run in the same direction, it's a herd mentality. They just follow whatever one is in front of it. Cows do the same thing. People actually do the same thing. A herd mentality. If you're at a football game and you see everyone running for the exit, what are you probably going to do? You're probably going to run for the exit with them because, well, why is everyone doing this? I should be following them. Basically, what this rule states is I can see and guess movements of stocks based off of how a large quantity of people act. So there's millions of people investing in the S&P. That creates a herd immunity. That's what it does. Okay, so the first wave is a new trend is established. It is an algo spike most of the time. Basically, a series of high frequency algorithms sift the overall market and wait for a new catalyst to hit. And then these algorithms, the second a catalyst hit, no matter how good or bad it is, it buys just to try to get on something quickly. What happens here is the first move, most retail traders don't trade because they're thinking, okay, is this a fluke wave? This is a counter wave to what's going on right now. Why is it making this move? I'm sure it'll probably be dead in a few minutes or whatever. And then what happens? The first pullback. The 5-minute pullback, the first counter wave to this new wave. Now, this is where fundamentals turn positive. This is where really good retail traders decide, okay, this is happening. This is a good catalyst. I've dissected it. I'm going to buy it. So what happens is a lot of these experienced traders purchase the first pullback. And then the bigger move generally is the third move or the second move to the overall trend. Okay, it's the third move higher. What happens is it takes the high of the first move and then usually explodes. Why does it start to explode? It's because the real retail traders understand that this is a new direction the stock is heading and they want to be in on it. So they buy it. Shorts are covered. Retail traders understand that this is a good catalyst, so it's time to start buying, and so they purchase the third wave once it breaks wave 1, and that's the second move off of the first pullback. One of my most profitable plays. Now, what Ralph Nelson Elliott realized is off of this wave, there's a massive surge in momentum because now traders are starting to adopt the fact that this is a new direction to the old direction. Okay, this is happening. This is going to continue higher. And what happens is one of those retail traders are complacent with their profits when they realize, okay, I think this is now a little overextended. A lot of the experienced retail traders map the size of wave 1. They paste it over the size of wave 1's top, for example. And I'm gonna go over it on the whiteboard. They realize, okay, this is a pretty good accurate price target. I'm going to sell here. And then what happens is there's another 5-minute pullback. Okay. This is why I don't trade much past the second 5-minute pullback, because after wave 4, the second counter wave to the overall wave, there's a massive feeling of FOMO. Inexperienced traders want in on this. They think, oh my gosh, this is going to the moon. This is not going to stop. Get in now. This is the cheapest price we'll have. This is, going to explode. I'm not missing this move. Yada, yada. And what happens is after the second 5-minute pullback, what happens? Very choppy, very emotional trading, very hard to profit on because a lot of inexperienced retail trader volume hits this wave and they have no idea what they're doing. They're just buying and hoping. So generally this fifth wave is extremely emotional based and is generally the last move to this new wave. Okay, or the last wave for this new move. Now, I don't usually trade this. Now, I say usually because sometimes if it's a really rocking catalyst, I'll trade it and it can make a decent move. But always, it's usually always much choppier than the first initial move or the third initial move. The fifth wave is a lot harder to trade because it's, like I said, very emotional based due to a lot of inexperienced FOMO trading volume hitting the market. Okay, let's move on. Let's look at an example. Ticker PIXY. Now, I don't think, Boss Trader is in the chat now, but I did call on him because I knew he did buy for the break of the pre-market high. And there's a reason why I didn't trade the break of the pre-market high. So what happened was at 8 a.m., retail or there was a catalyst and there was an algo spike. It went from $10 to $15. There was a pullback. And then after the first pullback, solid entry off the break of 15 for push up to 20. Okay, there's another pullback. Now before I continue, notice how similar the first wave is compared to the second wave. What we see here is the first and third wave are generally the same size. This is how I can predict where to put my price targets. So if wave one goes from 10 to 15, okay, that's a 50% jump. So after 15, I want to buy, or my last sell order should be 50% higher, generally speaking, after the break of 15. So that's usually 22.50 range. So I would start selling into 20, and then we have another pullback below 22.50. Pulls on back to 20, retest 20, and then there's a third move higher, and it's a really decent move. But as you can see here, is it's pretty choppy. It has a nice little breakout of the pre-market high, starts to move higher. You could probably profit off that second 5-minute pullback because a lot of retail traders are still trading it. And then what happens? The third pullback. Okay, this is where it gets really interesting, and this is where we see a lot of this trading volume, this emotional-based retail trading volume hit because they think, this is going to the moon. Look at how many times it faked out over the pre-market high. Not once, not twice, not 3 times, not 4 times. 4 times alone pre-market. And then there was a 5th time at market open, and it actually got halted going down. Is that choppy or what? Yeah, that's pretty choppy, right? Look at how FOMO based that is. Man, I don't know if it's going higher, and I should probably sell here. Oh man, it's actually going to go higher. I think I'm going to buy back in. Oh man, it's pulling back. Oh, it's halted going up right below, the all-time high. This is going to the moon. I'm for sure. Oh shoot, abandoned ship. It is really hard trading, team, and that's why I didn't trade that break of the pre-market high. And that's why so many of you guys lost on it. Not many. I think a few of you traded it. Because you wanted to see it go to the moon, and unfortunately it didn't. So that is a perfect example of the fifth wave, or the more emotional wave. Okay, now that is all there is when it comes to that overall presentation. But I'm going to go back over it on my whiteboard. Now, here's where it gets interesting. Remember, this is that first initial algo spike. Okay, news hits. All these retail trading bots are buying up the stock. Okay, they're pushing it higher. It's starting to hit scanners a little bit, and once it hits scanners, these retail market makers or these algos start selling around the top, and then it pulls on back. Okay, this is the best. If not, this is one of the best, if not the best plays in my entire strategy, because that's the first initial break of the move. You want to enter here. I sometimes take a starter before it breaks, but my main order goes on the initial break. Okay, so say for easy math, this is 5. So catalyst shoots up to 10. Pulls on back to 750. Okay, now where I base my price targets is based off of the low of this pullback. So for example, if it went from $5 to $10 and pulled on back to 750, can any of you guys do quick math and tell me roughly where my last price target should be, the high of this third move? Anyone? I did this exact staple at ProfitCon. 15. Dubon's got it right. So 15, the reason why it's 15, okay, really? I'm just going to, that's an S, idiot. I'm very nice to myself. There we go. That's 15. Now, the reason that is because this made a 100% jump off of the first initial move. So the second move should roughly be, the top of it from the bottom of the pullback should roughly be, it's not always the same, it's a rough estimate, 100% move. Okay, we saw this on PIXY. It was a 21% move and then another 22% move to the upside. This does not mean you should be having your entire sell order right here for the break at 15. You should be taking profits at 12, at 13, and then 15. Take your profits along the way. I need a paper towel, my gosh. Okay, so don't erase. Now, this is where it also starts to get really interesting. There's another pullback. It hits even more scanners. More traders want to trade it. And it goes up to 15 and pulls on back, I don't know, to 12, okay? Now, this second move generally isn't always as big. Sometimes it can be massive if there's enough hype behind it. GME, AMC, this fifth move was the biggest move. It was like a 200% gain. It was wild because that one got a ton of hype. This is all hype based. This is emotional retail trader hype. So the more hype, the better off of this move. However, the hype play can also work in a negative effect. If there's zero hype behind it, this can sometimes fake out, be a lot choppier trading, a lot harder trading. But I often still trade this move. Now, after the fifth wave, generally there's a third pullback. And then what you see is it tries to make a move to the upside, and then it continues lower. If I had better shorting privileges, this is where you would want to enter in on your short. After it tries to retest for higher highs, gets rejected, and moves lower, that's where you want to take your short. If you are a short bias trader, and I will be doing that in the near future. I can't right now. Unfortunate, I know, I'm trying. Now, does that make a little bit more sense? Does that make more sense on why I trade that on my entries and exits and everything else in between? Let me get a paper towel. I'll be right back, guys. I'm going to clean this off. I have more I want to go over. Oh, shh. Oops. These were my expos. These were my Sharpies.
Bruh.
Oh, I'm in trouble.
Surprise.
No, fat L. I got permanent Sharpies.
What?
That's so tough. Oh man, that blows. Yeah, they're all in my conference room. Well, let me clean this up a little bit. A few things to note is your starter positions can be really profitable. Let me dry this off a little bit more. Your starter positions can be really profitable if you start to add before it breaks. Now, my main order usually is off the break. However, I've found by taking starters before, it reduces my average in case it fakes out, in case it makes a much smaller move higher, anything like that. Now, the one thing I really want to go over, the last thing I want to go over, is the size of the pullback is equally as important as the size of the move. For example, we were trading ATXI yesterday, and I'm going to create a little bit smaller spark chart because that's all I got to work with down here. Now, you have to understand, in order to profit off of this move, I ended up doing this and then correcting after it broke. The reason why I didn't trade this move, okay, there's two reasons. You have to understand the difference between this high and the next high of the move is equally as important as the pullback. For example, say this is a 30 cent a share gain, okay, whatever. And then it pulls on back 20 cents a share. Your next move, if it's 30 cent a share gain from the high to the high, or sorry, from the previous high, from the previous high that moved to the low of the pullback, it should be just the same as this pullback. So for example, if this move to that move was 30 cents, this move to the next high should be 30 to 50 cents. And if it pulls on back 30 or 25 cents, that means after the break, it's only going to give us 5 to 10 cents a share in profit. That's not enough risk to reward ratio to trade off of, guys. It's just not, okay? It's not. So do not take trades if the pullback is almost the size of the initial move. It needs to be half of the first move or less. Anything more than that, it's not a pullback, it's a reversal. Or if it does continue higher, the upside is so much more limited compared to the move you could profit on. So, for example, if this stock skyrockets, I'm running out of room here, if this stock skyrockets and then pulls on back, and then your goal is to simply profit off of the bottom, the low of the pullback and the high of the next move. Say it does that. That's a good play. However, the way I look at it is there's only so much gas left in the tank. If you have enough gas to get from, say, Arizona to New York or whatever, that's a fair amount of gas. However, if New York's distance is 30 cents a share, we're kind of mixing and matching, then in order to get to New York is your goal, and it pulls on back 30 cents a share, you ain't getting to know New York, baby. You're getting halfway there. New York's way up here. You can't get to New York. You don't have enough gas left in the tank due to the pullback you had. It's like rerouting. You missed a turn almost. You have to add more time and more gas to your tank in order to get to your final destination. Does that make sense? That's how I think of it in my head. Hopefully that did make sense. If not, then you can tell me. But that is the 5-minute pullback to a T. You know why I trade it. You know the importance of it. You know how to profit off of it, and you know how to manage or assess your risk. Understand that this first pullback gives me so much data. It teaches me where I should be putting my price targets, how high roughly it can go, where I can plan my short entry up here, how to profit off of it when the FOMO buying is starting to kick in, and when to just kind of step away and scale back. The first pullback, the first move can tell me so much of the overall move, okay? A lot of inexperienced traders are going to trade this move, and they're going to be upset when it's only a 5 or 10 cent share break. That's not good. No bueno. ATXI, I can show you an example. Matter of fact, I'm going to do it right now because we have time. So yesterday, a lot of you guys were wondering why I didn't trade this move. And this is why. As you can see, I took 2 trades on it, profited on both. One was practically break even, the other one was a decent profit. This was the first pullback, a really solid move. To the upside, went from 270 up to 350, pulled on back to 313, and said, okay, there's roughly going to be another $1 share move, or $1 to $1.50 share move, so let me trade it. That's what I did. Bought off the low at market open, sold after it broke out. Solid move. But here's the problem. Let me clear my drawing set. Clear drawing set, and then I'm also going to not show my orders to have like nothing on here. Actually, matter of fact, I'm going to pull it up on the screen. Okay, so here's the first move. Look at that pullback from the high to the low. That's a decent sized pullback. Okay, that's almost half, if not more than half of the overall move. It's kind of big. So that meant that the initial break of wave 1 was not going to be as great, but I still thought there was profit potential, so I traded it. Boom. Okay, so then now I know the difference between the high of that previous move and the high of that move was literally only 10 cents a share. 10 cents. So I'm like, man, this next one means, max will be 10 cents a share. But here's the problem. It pulled on back from 360 all the way down to 323. That was a massive pullback. They rerouted. They needed to have more gas in the tank in order to get to New York. Getting to New York is very hard. That's the goal, but there's not enough gas left in the tank to get to New York and beyond. Because New York is way up here, man. In this example, New York's, especially where I live, Northern New York's 375. I need 25 cents a share of gas, if you will. Now, what happened was, because I knew there was only 10 cents a share potential profit from here to here, The reason I didn't take that trade is because, first of all, massive pullback, giving away most of its move. That's the first red flag. After it broke, I'm like, man, only to potential 10 cents of share in profit. So I can buy at 360, sell at 370, maybe. But the problem is every time you see this gap from high to high, it generally gets smaller and smaller. So the gap from the first high to the next high was pretty small, meaning the next gap from the second high to the third high is going to be even smaller. So I knew it was going to be 10 cents a share or less. Turns out it was 3 pennies a share. No bueno. Okay. Makes sense? Cool. Another example, strong move to the upside. Only problem is this had a pretty massive pullback, but I think it's because it was pre-market. So a lot of that doesn't really help that much. Matter of fact, I don't know if I want to go over this example. I want to have a cleaner example. PIXY was a really good one. I think you guys get the point. I gotta go on the marketplace and buy a new whiteboard because I'm a dummy and I bought I bought Sharpie's permanent marker. That's a fat L. But already all that's going to do it for the group lesson today. Do you guys have any questions that I can go over about the 5-minute pullback? I'm glad that that made sense. I really do like. I'm a visual learner, right? And I think a lot of you guys are too. So the more real person examples I could do, the more whiteboards I can do to kind of illustrate it. I know I'm not the best drawer. However, I do think the more in depth I go in the market, the better it's going to be for all of us trading. Our goal is to have the most in-depth and best education in the entire world, and we're not going to stop till we get there.